Hey, everybody. Welcome, welcome, welcome. Welcome to the 1099 CRNA Success Community. And I really want to welcome our special guest from Neo Home Loans, josh.mettle. It is just such an honor to have come across him. I couldn't help but reading some of the blog that he's written. And then I spoke with some of the folks in his office, finally had the honor of meeting Josh. And Josh really has the information that we need to know about mortgages, about what is going on in the market, about what we need to do as CRNAs that have been W-2, that are going to 1099, how we need to work our mortgage in. So it is my absolute honor to bring to you guys josh.mettle. So thank you, Josh.
My pleasure. It's great to be here with you tonight. I'm not in my normal home office. I'm camped out at a hotel in Arizona coming to you. So hopefully the internet goes well. It's great to see everybody coming in, and I'm happy to be here tonight. Thanks for inviting me, Alicia.
You're welcome.
So, the question that we're getting, and I'm sure you're hearing this in your groups all the time, is what is going on with the housing market? What is going on with the economy? And really, is the housing market about to implode? Should we be running for the exit doors? And so I hope to bring you as much live time data to answer that question as possible, because there's a lot of conjecture, there's a lot of opinion, and there's a lot of fear mongering. So we're going to talk about the good, the bad, and the ugly. Alicia, if you don't mind, before I get into that, I thought I'd just give everybody just a kind of a really quick background. I have been in the mortgage industry for the last 22 years, which is really cool. The last 12 years, I've been working mostly with medical professionals such as CRNA and physicians and dentists and veterinarians. And so I get to see thousands of people's loans applications, right? I see the income, I see their liabilities, I see how much credit they're using, if they're overspending, and really what their thinking is as it relates to the real estate market and the economy. So that's a really interesting perspective, that I get to see that many people's kind of financial situation.
Absolutely. That's a great inside scoop, isn't it? So you can really see the flow, ebb and flow of what's going on in the market, what's getting accepted, what's not.
Exactly. Phenomenal. And from all across the country, which is really interesting. We lend in 49 states. But the other thing, Alicia and team, that is kind of interesting about some of the stuff that I'll share with you tonight is that for the last 20 years, my mother and my wife and I have built a real estate investment business. And so today we co-own and actively manage over 200 rental units across Utah. So we have houses and condos and fourplexes and 16 plexes and medical office buildings and retail centers. And so when I put together a presentation like this, it's not just to kind of do it as if I was just presenting as a mortgage lender, but I'm literally doing research because I'm trying to figure out what's happening in the marketplace and how should I be making different investment decisions because of that. So just wanted to give you a little bit of background there before we jump in. Alicia, any other questions?
Oh, no, you're hitting all the high points. And yep, I'm glad you told us about what the background is. That's great that you've got a couple of power women on your side that are part of your business. I think investing is so wise, and especially when you do investments in multiple units. And so when you are doing that, are you bringing buddy investors in, or is it mainly just you guys as a small group?
Great question. Up for the first 15 years, it was just myself, my mother, and my wife. And by the way, we call them boss 1, 2, and 3. Boss 1 is my wife, boss 2 is my mom, and boss 3 is my daughter. She's 11.
Of course.
So I have a lot of bosses.
That's perfect.
Yeah. But for the last about 5 years, we've brought outside investors in because we bought some pretty large medical office buildings, which have been fantastic investments. If we want to do a future segment on that and all the reasons why how people get paid in real estate investment, I'm happy to talk about that as well.
Love that. And especially a lot of people who are 1099, the next step that they do is they often negotiate contracts to cover anesthesia departments and offices and critical access hospitals and ASCs. In many states, the CRNA can be the medical director. So they're buying buildings, they're setting up surgery centers, they're bringing in docs, and they're setting up the anesthesia billing, you know. So that is a great fit. We're going to do that.
You know, I believe that McDonald's doesn't make the best hamburger in the world, but I think they might have the best hamburger business in the world. And that is all about Ray Kroc's fundamental understanding that we want to control the land and we want to put a business on top of it that spins off enough income to pay for that land. And look what happens in 30, 40, 50 years. The business does pretty well. Brilliant.
Yes, I love it.
All right, team. Well, let's jump right into the topic at hand. And Alicia, if you will you just give me a thumbs up when you can see my screen?
Okay, I see that you've started screen sharing, but it is a black screen right now. Oh, there we go. And now I'm seeing everything from beginning. Yep, you're hovering over that.
Perfect. Okay, here we are. And one more thing here.
Looking beautiful.
Thumbs up. Thank you. All right, and one more thing, I would just invite you, team, as you're watching this, feel free to stick your comments or questions in the chat, and Alicia will pause me and we'll go through it. So again, the idea here is to really answer the question: where are housing prices headed? Is the market about to implode? What's going on? And help people move from conjecture and fear to data-driven confidence. And we're also going to talk a little bit about specifically what the CRNA home loan is and why it is here to help. So here's the thing. Home prices, the appreciation rate is decelerating nationally. And if we look in some markets, some of these markets that have had massive run-up, right? The Boise, Idahos of the world, we're actually seeing a slow tick down or reduction in the price of those homes. But if we look nationally, we can see that so far in the last monthly print here, which was August, that we got from Case-Shiller 2022, the year-over-year appreciation is about 13%, but we can see that's down from 20%. So definitely the pace of appreciation is decelerating, and in some areas of the country, we're seeing prices go down. Now, I like to remind people that when we say that prices are slowing down, and in some areas they're going down, this is on the heels of the most unbelievable appreciation time of all time. I mean, in Boise, Idaho, we saw 34% appreciation in 2021. In Utah, we saw appreciation above 30%. Like, these were just crazy appreciation years. And there is definitely some normalization that is happening. I think the market needed it. And really the biggest, I think, future risk to home values is how long interest rates stay elevated. And we're going to talk a little bit about that today, but mostly what we're going to focus on is 2022 just like 2007? What's the same, what's different, and what are the major risk factors that we're going to talk about today? And again, just for context, keep in mind that if we look back over the long term nationally, historical appreciation rates in real estate has been closer to 4%. But if we look back from January 2020, which is when the Fed aggressively began to engage in quantitative easing and started to really buy down mortgage interest rates through the quantitative easing programs, we saw as the rates went down, home appreciation just went parabolic. And you'll see this is basically each of these numbers that you're seeing is just a year-over-year appreciation. So we went from this kind of 4% range up into the 20% range nationally, and obviously that wasn't sustainable. The thing that I like to keep people, I like to remind people is that in 2007, the vast majority of loans that were being written were adjustable rate mortgages. And today's mortgages that are out there across the country, by the way, 40% of all homes in the United States are paid off. They're free and clear, completely free and clear. A lot of those may be owned by hedge funds and investment funds and mom and pop investors and people who've just paid off their residential homes. But of the 60% of homes that are encumbered by a mortgage, 65% of those mortgages are 4% or lower, and 24% of those mortgages are 3% or lower. And the vast majority of those loans today are fixed loans, either 15, 20, or 30-year fixed loans. So we don't have that same kind of issue that we had in 2007, where people were borrowing 120% of the value of their home. They're on adjustable rate loans. And as interest rates went up, all the payments on those mortgages went up. No, today, most of the mortgages in the country are locked at very, very low rates. So new housing affordability is an issue, but the people who are already in their homes, they're doing pretty good. Now, you know, housing bubble fears are nothing new. This is just a screenshot of all of the kind of scary headlines around housing going back to 2015. These actually are all headlines from Diana Olick, who's the head of real estate for CNBC. And you can kind of see, you know, going back to 2015, hey, housing's in a bubble larger than 2006. We're in a housing bubble. Home ownership doesn't build wealth, so on and so forth. You can read quotes. And then each year, what we did is we just wrote the corresponding appreciation rate, cumulative appreciation rate for that entire year nationally. And the point is that if someone would have read this news in 2015 and they would have been trying to time the market, okay, I'm going to wait for this housing bubble to burst. Well, they would have lost out on the average American, if you look at housing values across the country and then the appreciation rate over that period of time, the average American would have lost out of $222,000 of appreciation. So, you know, trying to time the market in housing is tough. And if we're doing that based on media sound bites, it hasn't been successful. And so what I believe is time in the market will make somebody more successful in their investing, whether it's real estate or anything else, than timing the market. Mm-hmm. So here's the situation with supply, okay? And I think if we think about really the difference between 2007 and where we are today, we really need to know what's going on with new home construction. So if we go back all the way to 1959, so, you know, we're talking 63 years here, we can kind of see that, and by the way, this is 1,400, this would be 1.4 million. These are the number of housing starts going back 63 years. And you can see that kind of on average, we built about 1.5 million homes going back that 60-year period. But we got a little crazy with new construction in the lead up, let's call it from 2004 to about 2007, when things started to turn around. We started building above the trend line in terms of new homes. And then when the Great Recession came, boy, the number of new housing starts went down to just a little bit over 400,000. And so we have this, what I'll call this, you know, decade, if you will, the lost decade, where builders weren't keeping up with demand. We broke below the 1.5 million housing start trend line in 2009. And we really are just barely back to that 60-year historical average. But between 2009 and 2022, you know, you've got 13 years here where the home builders were building less homes than we were, you know, we had demand from household formation. So we have to know that going into this slowdown in the housing market, we're doing so with a lot less homes that were built. And still today, Alicia, there's not enough housing completions, new houses being completed to even meet demand. And so this slide talks a little bit about the number of housing starts completed based on the monthly numbers. The last 12 months, there's been 1.3 million houses completed. These are not applications, but actually homes completed. Now, there's about 100,000 homes destroyed annually. So think about a home on an acre lot. builder comes in, destroys the home, and builds 2 homes on top of it. So we've got about 1.3 million homes that are completed. You have to take out about 100,000 that get destroyed every year. That gives us total new supply of 1.2 million. But we're household formation. We're projecting 1.7 million household formations this year. Well, what's household formation? Well, I've got a 13-year-old son and an 11-year-old daughter. And when they move out of my home, there'll be 2 new household formations. If a married couple gets divorced, that counts as a household formation. So we're bringing to the market 1.2 million new finished homes per year after we account for those that are destroyed. But we're bringing 1.7 million new household formation. So we had 13 years where builders weren't building enough homes. And on top of that, even today in 2022, we're building about 500,000 less homes per year than we need to keep up with household formations. Granted, not all those people are going to become buyers, but keep in mind this housing start completion numbers. This includes both multifamily apartment and single family homes. So we're just not, whether it's renting or buying, we're just not bringing enough new supply to market to keep up with the new household formation. And if we look at housing inventory, so this is from the National Association of Realtors, and they report back, how many homes are on the market for sale at any one period of time. And this goes back to 1980, just about here. And if we look back over the last 42 years, kind of on average, there's been about 2.5 million active listings. These are single family homes listed by realtors all across the United States. This has kind of been the average. Well, what happened over here in 2005, 6, 7 is that inventory peaked all the way up to 3.8 million homes for sale. And if we contrast that with today's inventory in 2022, we have about 1.28. The last number I just saw was 1.3 million homes for sale nationally. So we have builders who didn't build enough homes after the Great Recession. We have more house formations than we are bringing new product to the market currently. And we're sitting on a lot less inventory than we saw in 2007. So very different from that perspective. Now, this is kind of interesting, and I'll go through this quickly, but I think it's important. The National Association of Realtors tracks inventory, as I mentioned. And if we look back to 1992, so going back 30 years, this green line is kind of the trend line. So we see that in 2007, inventory got very high. And if we go today, we look at inventory about 1.3 million. Now, on the next slide, this shows homeowner appreciation over that same 30-year period. So the red line, Alicia, is 0. That's no appreciation. And if the blue line is above 0, that means we have positive appreciation. If the blue line goes below the 0 line, that means we actually have depreciation. Housing values are going down. But here's what's really super interesting. If we lay these two over each other, and I know this is a little messy, I'll walk you through it. It tells us a little bit of a story. What it tells us is the black line is inventory. And when inventory is low, we're likely to get an increase in appreciation because there's more buyers than there is sellers, and we start to get this elevated appreciation. And the opposite is also true. When the black line goes above the green line, meaning we have more inventory than normal, and like we did in 2007, then we get depreciation, home values going down. So this starts to tell a pretty interesting story. And we'll see that today, if we look at, or this is probably August of 22, because some of this data is a couple of months delayed. You can see that we've got about 1.3 million homes for sale, and we had appreciation rates that were, well into the 20s. Now this is slowed down into the 13% range. But the point that I'm trying to make is When we have to get really nervous is when we start to see housing inventory increase over about 2 million. When we see housing inventory over 2 million, that means we are very likely to see kind of widespread national depreciation. But if up to this point, we're not really seeing that. One more slide that kind of compare 2007 to today. You know, in 2007, there was 116 million households in the United States. Today, there's 129.9 million households in the United States. So roughly 14 million more households, which are people that either need to rent or buy, and there's about 2.7 million less homes for sale today. So you've got more buyers, less properties for sale, and that's going to be a buoy for home values. Even though, you know, even though interest rates and affordability are definitely going to slow the number of buyers coming into the market, it's happening at a time when inventory is very low, and we're creating more households than we are building homes to put those people into. Again, another difference, you know, and again, I'm going to make a lot of parallels and kind of juxtapose 2007 to 2022. And this slide, I think, is really telling. So let's just look and see what these lines mean here. The gold line, if you will, or yellow, is the outstanding mortgage debt. And this axis is in trillions. So you can see that in about 2008, mortgage indebtedness peaked at right about $11 trillion. But look how fast it went up. From 2000 to 2008, mortgage debt in the United States went from 5 trillion to 11 trillion. So that's over 100% increase in about 120% increase in just 8 years. So that was a big run up in debt. Now, here's what's interesting. From 2009 all the way over to 2022, household and debt, mortgage indebtedness in the country only went from about 11 trillion to 12.8 trillion. And now we have, obviously, you know, a lot more value of homes. So the blue line is equity. This is how much equity that homeowners have. And of course, after home values peaked in 2007, the amount of equity that buyers had went down. But today, home buyers are sitting on $27.8 trillion in equity. And the difference here really is, and if you look at the total value of all the residential homes in the United States, the total value of homes is about $40.5 trillion. So what's happened here is that we've had a big run up in the value of homes, but people have not used their homes like an ATM machine like they did from 2000 to 2009, when essentially mortgage indebtedness went up 120%. And between then and now, mortgage indebtedness has only gone up about 10%. So that kind of tells you a little bit about the way people have shifted using their home equity after the Great Recession. The other thing that is important to understand is the quality of loans that have been written over the last 13, 14 years. And this is put out by the Mortgage Bankers Association. It's called the Housing Credit Availability Index. And the higher the number, the more risky the loans. The lower the number, the more conservative the lending environment. And they bifurcate this into two different risk categories. There's a product risk. Product risk would be the types of loans. For example, back then, Alicia, I don't know if you remember this, but there were companies that were offering—
Do I ever?
Craziness.
It was nuts.
Yeah, I mean, there were companies that were offering 125% home equity lines of credit. So if your home was worth $400,000, they'd loan you $500,000. There were loans that were fixed for 2 years, but had a 5-year prepayment penalty. So if you tried to refinance or sell your home, you have to pay this big, huge prepayment penalty. And when interest rates went up in that period, a lot of those loans were adjustable rates. So the people inside those mortgages each month were going, okay, my payment's $1,000. Okay, 6 months later, it's $1,400, 6 months later, 2,000, and now I can't make those payments. Well, today, virtually every loan is a 30-year fixed, 15-year fixed, or sometimes there's a 7 or 10-year arm, meaning that it's maybe a 30-year loan, but the interest rate is fixed for 7 years or 10 years. By the way, the average person keeps their home for 7 years. Keeps their loan for 7 years. And the average person is in a home for 10 years. So basically people refinance every 7 years on average, and people move every 10 years on average. So you don't have these situations where 2 years into a family living in a home, the interest rate goes sky high, but they can't refinance because there's a huge prepayment penalty. So there's virtually, since 2009, really, there's very little product risk because everything just went very vanilla.
Yeah.
Rate or 7 to 10 year fixed arms, no prepayment penalties. But there's also a lot less borrower risk. So, the average credit score is drastically higher than it was in 2006, 2007. You actually have to, prove some income, which we're going to get into. You have to show your assets. You actually have to have an ability to repay a loan. And back in these years from 99 to 2007, let's just call it, you either had to fog a mirror or be able to spell your name, but you didn't have to do both. If you could do one of those two things, you could get a mortgage. And the fundamentals of the mortgage industry going back to 2009 have just been a very different world. You have to really qualify for those loans. Again, if you have any questions, feel free to jump in, Alicia or team. So this is, I talked a little bit before about timing the market. And what I like to encourage people to do is to understand that, if you're going to be in the home for 2 or 3 years, and we're in this kind of a changing real estate environment where the appreciation levels are decelerating in some coastal areas or really high run-up areas, values are actually starting to come down. And we don't know how long interest rates are going to be elevated. I've got theory on that. I'm happy to answer questions about it, but nobody knows for sure. And in those periods of time, the shorter duration that you plan to hold your home, the higher the risk. But if you plan to be a long-term owner of property, real estate does pretty good. I happen to be proud to have spent the last 30 years of my life in Utah, and over the last 30 years, Utah has seen 621% appreciation in residential real estate, which is crazy. And cumulative appreciation over that period of time across the United States is 307%. So time cures all in real estate, and the longer you plan to be in your home, the less risk it is. The shorter amount of time you plan to be in the home, the more risk it is. One last thing I'll lead on this, and then we're going to kind of get into what the CRNA home loan is. One of my favorite mentors is Jim Rohn. And Jim Rohn is a motivator. He's kind of the godfather of personal development. He was Tony Robbins' personal mentor. And Jim Rohn has this quote. He says, success leaves clues. If you want to be successful, study successful people. And that's something I always remembered. And I found this little piece of content, and I thought I would throw it in here because it just shows that success leaves clues. So this is net worth, not income, but net worth. So you want to know what the top 1% are worth? They're worth 10.8 million. And top 2% are worth 2.5 million, top 5%, top 10%. And if you're in the top 50 percentile of net worth in the United States, you have to have a net worth of 500,000 or more. But here's what I thought was really interesting. The cliff notes in this article said that on average, 2/3 of the net worth of all of these individuals was in the form of home equity. And again, I think, especially right now, real estate is showing to be an incredible inflation hedge as the values have gone up, but those 30-year fixed or 20 or 15-year fixed mortgages, those people that are in those homes, they have a fixed mortgage payment as rents continue to move higher. All right, I'm going to pause there for just a second. I'm going to move from kind of a market background into really talking a little bit about CRNA home loans. Then we're going to talk a little bit about taxes. But before we do that, Alicia or anybody in the audience, does anybody have any questions for us? I
Well,
don't
that
see
was
anything
just
in
an
the chat.
incredible summary of what's going on and why we are here where we are today. And I love how you keep referring back to the 2007, 2008. And,
Yeah.
you know, I'm always telling people, you know, as long as you're in the real estate market in some way, things will always come back around. You know, at some point, you know, you're going to be way in the plus for having gotten into real estate. It's really hard, I think. I mean, except for times like 2008 to take a huge loss. But, you know, I'm a total neophyte at that. But yeah, I love your summary. That was really enlightening.
Yeah, and I remember that time. It was a really fearful time for me personally. My wife and I at that time had about 52 rental properties, as I recall,
Wow.
and the values were going down so
Yes.
fast, and the news was so negative. I remember hearing this one report that they estimated it would take 20 years of appreciation to regain what was lost in the previous 2 or 3 years. And I thought to myself, wow, this is just a no-win situation. And by the grace of God, we had just enough cash flow from those rental properties to keep everything afloat through that thing. And within 2 years, the vast majority of those losses had actually been regained. Now, again, I was in an interesting market, right? I was in Utah, which you just saw was literally the fastest appreciating market over the last 30 years. But we had most of that equity back in 2 years. And as I look back at that time when a lot of people were just throwing up their hands and saying, hey, we're out of here. And granted, some people had to do it. Like some people lost their jobs and they said, I either got to feed my family or I make this mortgage payment that has this terrible loan product tied to it. And I can't make the payment. I get it. But there were also another segment of the market who just said, I think it's in my best interest just to give this back to the bank and you can have it. And the reality is a lot of those people probably could have rented those homes out, probably could have squeaked by, and they would have regained that equity a lot faster than they thought.
But I think the government at that time made it really easy to give it back to the bank because they were doing short sales and deed in lieu of foreclosure, but you were getting a some sort of tax benefit where if you did that, you didn't have to pay the short sale, the remainder, you didn't have to pay taxes on, you know what I'm talking about? Taxes on what your loss was.
You're spot on. So, if you short sold a home for 300,000 and your mortgage balance was 100,000, the previous tax laws would have said, well, you have to pay taxes on that 100,000. That was essentially a gift from the lender, basically.
Correct.
And they waived that during that time. And yeah, it was.
Yeah,
It was rough.
Bush had a law and said, if y'all want to get out, and you won't have to pay taxes on that.
They should have put landlord courses and real estate investor courses at that time. It was interesting. At first it was really scary at that time, but then all the people that were leaving their houses all became renters. And that was actually one of the best times to be a landlord because all the owners couldn't qualify to buy a new home and they all became renters for a few years. So it was really kind of ironic. Yeah. All right. Well, I don't see any other chat questions. Again, team, feel free to throw those in the chat. I'm going to kind of just move on to the next segment here. And we're going to talk just a little bit about what is a CRNA mortgage. And so, when I started in this field, ironically enough, it was right after the mortgage meltdown. And a lot of the big banks that had been doing medical professional loans, mostly physician loans at that time, they just completely pulled out of the space. And I remember working with a young family who literally was relocating across the country. They were about to start their new job. It was a future employment deal where they hadn't actually started their job. They didn't have a paycheck stub in hand, so they were qualifying off their employment contract. And they got to the day before their closing. This is an absolute true story. The day before their closing, the young man and his family are in the U-Haul van driving across the country to Utah. And the loan officer called him up and said, I'm really sorry. I forgot to count your deferred student loans into your debt to income ratio. Your credit report said 0, and I didn't factor in a payment. My underwriter did not make the same mistake that I did, and your loan's been declined.
Ouch.
All their money was tied up in earnest money for the home. He was to start his job the next Monday, so they were supposed to arrive on Thursday, move into the house on Friday, or close on Friday, move in over the weekend, and then he's to start his new job. And all of a sudden, he's homeless and he's lost all of his earnest money because he can't perform. And that was really one of those stories that made me realize, okay, I have to get deeper down this path and figure out how we can, how we can help medical professionals overcome these challenges. Happy ending to that story. 2 weeks later, we got him a short-term rental. 2 weeks later, him and his family moved into that home, and we found a solution. But what we've learned over the last 12 years is that medical professionals have this unique set of challenges. Student loan indebtedness, in and out of forbearance, limited down payments because they've been, in many cases, because they've been spending so much time getting through education and so much money getting through education, oftentimes wanting to qualify for jumbo loan amounts with limited down payments. And in many instances, there's, as in the case of our audience here tonight, there's some sort of self-employed structure of their income that makes it harder to qualify. Now, the reason why it's harder to qualify is because in the wake of the mortgage meltdown, there was a set of laws called the Dodd-Frank Act that were passed. And in that body of legislation, it said that it is actually illegal for a mortgage lender to lend on a residential primary residence if that lender has not proven the borrower's ability to repay. And if you do that, if you're found guilty of making that loan in violation of the Dodd-Frank Act, then you have to forgive, the mortgage company has to forgive all the interest and all the payments that were ever made on that loan. So it's a massive penalty. And terrible. So it's terrible. Yeah. And so we've spent the last 12 years trying to figure out, how do we solve for those challenges? The student loans, the limited down payment, future income, somebody who's relocating across the country and doesn't have a paycheck stub, somebody who's newly self-employed. So the CRNA 1099 program is one that does not require the same thing in terms of qualifications than would a conventional loan. Now, this isn't necessarily a panacea that'll overcome every challenge, but we overcome a lot of challenges that other institutions cannot. So just a few quick highlights here. As little as 5% down, jumbo loan amounts are okay. There's both 30-year fixed and 7 to 10-year fixed adjustable rate mortgages, where the 30-year loan fixed for 7 to 10 years. So both those are available. Credit scores down to 680. And here's the real important thing, I think, for this group. We need evidence of if we have evidence of a 1099 contract showing guaranteed pay, and it's going to continue for at least 1 year, we're good. As long as we can show that somebody has a guaranteed contract for at least 1 year, we're good. Or if someone is 1099 but doesn't have a 1099 a guaranteed contract, let's say they're on some sort of production, then we can show 1 full year's tax returns. So it's much more liberal in the underwriting guidelines than conventional loans. And we just started working with a brand new investor partner that will take another approach to calculating the income from someone who's production based. And that loan requires a little bit more down. It requires 20% down. But if somebody is brand new self-employed or brand new 1099, no guaranteed contract, we now do have some solutions for that situation, but it does require 20% down.
That's great. So what you're saying then is that a 1099, somebody who is going into 1099 from W-2 can show a contract of 1 year and qualify for this type of loan, which is phenomenal. And now
That's right.
I noticed there is a question where somebody's saying, can a W-2 CRNA qualify? And so this is a little easier for you, I would imagine, right?
Much easier. Yeah. We have 6 different medical professional loans. And what we do when we consult with somebody is we figure out what their employment situation and down payment and purchase price objectives are. And then we will plot them for the loan that will give them the absolute best terms based on their situation. But if someone is W-2, it's usually much easier because an underwriter says, look, W-2 employees can't write off expenses for mileage and travel and those types of things. It's already netted out of their W-2. But a 1099, somebody who has an S corp or some sort of a tax structure like that, they could have all of these write-offs. In fact, we just had we're in the process. We just approved a loan. Literally, this is happening live time this week, where the husband and wife are dual CRNAs. Their combined income into their respective S corps, which they each own like 49% of each other's S corps, so it's a little wampus.
Wow.
But there's combined gross income before deductions is over 500,000.
Yeah.
Their net income after all of their deductions, and by the way, they have another side business that is I won't give you too many details, but it doesn't make money. But so their net income is closer to about 150,000. And then if you look at the rest of their, expenses and their allocations, they really only qualify for about a $600,000 home. They'd been turned down by 4 other lenders when they came to us. And we were able to get them qualified. We were able to add back in a lot of those deductions and get them qualified they had a new construction home under contract for about $1.2 million loan amount. And we were able to get them approved for that loan.
Oh,
so if you're W-2,
great.
it's easy. If you're self-employed or 1099, we really need to have a consultation with you, walk you through what your hurdles may be and go from there.
Right, because I can imagine that when you're claiming a reasonable compensation, so of course you want to try to get that lowest reasonable compensation as a self-employed, an S corporation structure. So now you've got this low looking income, but in fact, so it's really good you take away some of the expenses. And so now you're looking at a much greager revenue.
That's right.
So
Yep.
That's cool. You got more
there's
questions.
A lot more. Oh, good. Good.
Yeah.
Let's see. You want to read them to me, or do you want me to?
Okay, I'm going to read this one to you. Thanks, Alicia and Josh. I lived through those 07 real estate times as well, riding the market up and down, becoming underwater. We wrote it up, down, back up, contrary to our attorney, CPA. We are completely appreciating a different market right now, market appreciation. These were commercial properties, a different zebra, but it goes to show you that if you hang on through the bad times long enough, things will appreciate over time, as Alicia describes. To date, our ability to hang in there for the long haul has most definitely set the bar as how we function as an investor group. So glad to see you bringing in resources to give a leg up to our 1099 colleagues entering into this arena. Bravo, Alicia. Isn't that sweet? Thank you so much. That's really kind. Let me tell you, I looked long and hard for these people here for Neo Home Loans, and I just kept coming back to them. So I'm just so glad that I did. Yeah. So Kay wants to know, what if I get a pre-approval in W-2 and then I switch to 1099?
That is a great question. We need to think through what that 1099 contract is going to look like. If you get a pre-approval on a W-2 and you close the W-2, you're fine. But if you switch midstream, that is not going to get by an underwriter. Trust me, they're going to want to reevaluate whatever that 1099 income is based upon. So we would want to think 2 steps ahead and say, what does that new 1099 contract look like? And then we would either advise you, hey, we can do that, but you would need 20% down, or yeah, no problem, there's a guaranteed component to that new 1099 income, or pause, buy a house before you go 1099. We'll advise you which way to go.
Right, and that's a good idea. And the other question, the other side of her question is, are the interest rates higher if you, than going the more conventional route? If you are 1099 I know you said you do have a greater down payment, right? But do the interest rates, are they different?
It depends on the program. I mentioned previously, I think that we've got 6 different programs, and the most the highest qualified CRNA program would actually be better than a conventional rate, because
Right.
there's either no more, if someone puts less than 5% down, there's either no mortgage insurance or the mortgage insurance is discounted by about 60%. So that program is actually has lower costs. And then if there's programs that you wouldn't, that based on your income structure or whatever your situation is, maybe you have a 680 credit score, maybe you're trying to buy $1 million house with 5% down. So those kind of parameters aren't going to qualify you for conventional. Then you might pay a little bit more than a conventional loan, but not in all scenarios. You're either going to get, if you're really well qualified, the terms should be better than a conventional. If you don't qualify for a conventional, then they may be marginally higher.
Makes sense. Thank y'all. Great questions. Great feedback.
Yeah, awesome questions. Okay, I think that's the end of the questions. So I will keep those questions coming, by the way, and the comments. Those were really wonderful. I'm just going to jump right back into here. I'm going to jump right back into this presentation from current slide. Okay, this is something else that Alicia, I think you had
Perfect.
said, let's touch on this. So let's make sure we do that.
Great.
There has been a lot of changes as it relates to interest deduction. And so, in many instances, when your CPA or whoever's preparing your taxes, TurboTax might advise you, hey, the standard deductions are going to be better for you. If you're 1099, my guess is you're doing an itemized deduction. And if you're itemizing your deduction, then you can still write off mortgage interest. A lot of people think, the new tax laws, I can't write off mortgage interest. No. That's only if you take the standard deductions. Then if those exceed your itemized deductions, then you're better off just taking the standard. But if you are itemizing, and by the way, I am not a CPA and I am not an attorney, and so we got all of this information from the IRS's website. But we are not giving you tax advice to your personal situation. I'm giving broad stroke information I found on the IRS website. I suggest you talk to your CPA, but this is how we understand it from what we read and the feedback, of course, I get from my CPA.
Good disclaimer.
Yeah, thank you.
I love it.
Boy,
Just in the nick of time.
I gotta have a get out of jail free card here.
That's right.
Yeah. So what that 2017 TCJA, as they call it, the Tax Cuts and Jobs Act of 2017, just basically limited the amount of interest deduction to the first 750,000 in principal value. So you can write off a little less of your of the interest on the first 750 in loan amount. So know that there is some limitations there. If you like the case I just talked about, that CRNA family that was buying their loan amount was 1.2 million. Well, they're not going to be able to write off all that interest. The only interest on 750,000. So that's one change in limitation. Another kind of change is called the SALT deduction. And this is your state and local taxes on your property, which used to be deductible to no limit. So if you had a $1.5 million house and you had a big, massive, I don't know, $30,000 a year state and local municipality taxes on that property taxes, you could write off the whole 30,000. Well, now it's limited to 10,000. So the tax deductions around housing has come down, but if you're still itemizing and you're not taking the standard deductions, there's definitely still some deductions there that will help you offset the cost of that mortgage interest. Alicia, anything you want to add there? Any questions you have?
No, you hit it. It's
okay.
Beautiful. Yeah.
Perfect. The other thing I thought we would talk about, because there has been, just a little bit of changes around here, is what happens to capital gains tax if you sell a primary residence. So first of all, let's just talk about short-term capital gains tax. Is the tax on profit from a sale of an asset held for 1 year or less. And the short-term capital gains are generally taxed at your ordinary income tax rate or your tax bracket. So I just threw up the tax brackets here.
There it
And
is.
yep, there it is. And keep in mind that the US tax system is a progressive tax system. So what that means is that, if you're in this income range, let's just say you're married and you're filing jointly, and let's just say let's go to this income range. Let's say this is your income range. Well, people say, well, I pay 32% in tax, federal tax. Well, it's not really how it works. What happens is you pay 10% on the first 20,000, then you pay 12% on the next 63,000, and you kind of pay it in tranches, so it's progressive. So you could say, hey, somebody who's in a 32% top end tax bracket, really, if you blend all these tranches together, maybe I'm only paying 26% in blended tax. But whatever that number is for you and your tax rate, that's what you would pay on short-term capital gains. Now, if you and then if you hold it more than 1 year, then you would be subject to long-term capital gains. And long-term capital gains rates have a different algorithm, I guess, or a different breakdown. Different tax rates is the right way to say it, based upon different incomes. So, if you are married filing jointly and you make between 83 and 517,000, then you can expect to pay 15% of that in long-term capital gains. So that's good to know for both owner occupied and investment. And then for owner occupants that hold their homes greater than 2 years, actually the law is that you live in the home for 2 out of the last 5 years. So you could live in the home for 2 years, you could rent it out for 3 years, and on the month before you got to the final month of that 3 years of being out of the home, you sold it, you're good. You're in the home for 2 of the last 5 years. You get to take this capital gains exclusion. So basically what this says is if this is on your primary residence, and if you're single, the first 250,000 of taxes are excluded. There's no taxes on that gain. And if you're a married couple and you've been in your home 2 of the last 5 years, you get to move up to $500,000 tax-free. And then anything above that would fall into your long-term capital gains, which would be, kind of the rates that we talked about here. Mm-hmm. Alicia, that was a lot. I want to pause and just see if that landed for you and if you have any questions around that.
Absolutely. I have never really, I totally get the marginal tax rate, but the capital gains taxes and exclusions, no, I have never really, I knew it existed, but I wasn't sure about that. So that was very clear. I think it is so funny, the difference between single and married. Boy, the government wants you to be married, don't they?
Boy, they sure do.
That's quite an exemption at 500,000. So
yeah, I'll tell you my other takeaway. Oh, go ahead. Sorry.
So what about if that's your first home, not your second home too? Or
yes, it's as long as you have lived in the home for 2 of the last 5 years. So I have seen a lot of people employ this type of strategy. They buy a property as a primary residence, they move into it for 2 years, they then buy another property as a primary residence. This is house hacking, right? And the reason why it's important for primary residence is because you get lower interest rates and lower down payments on a primary residence. So they buy the first one, they live in it for 2 years, they buy a new one, they wait for 2 or 3 more years, they rent out that first house while the value goes up, and then they sell that house and they still get a write-off up to 500,000 of that gain. as long as
Wow.
you've lived in the home for 2 of the last 5 years.
So
That's a
clever,
pretty,
just knowing the laws. Yeah,
totally.
love
Yep,
it.
absolutely. Now, one
Beautiful
other
system.
takeaway I was going to mention is, look at the difference in taxes, Alicia, between short-term capital gains and long-term capital gains. So if we're married and I'm in this tax bracket, this income bracket, 83,000 to 500,000 as a married couple, I'm going to pay 15% if I hold in taxes, if I hold the home in federal taxes, if I hold the home for greater than 1 year. But if I sold the home on the 11th month and 29th day, then let's go there. And let's say I'm in this tax bracket. Well, then, oh, and here's the other thing. Here's the other thing that, boy, people need to understand is, let's say that I'm in a 24% tax bracket and I sold my home in less than 2 years. So I'm going to pay let's say I sold it less than 1 year. So I'm going to pay short-term capital gains. Well, if I made $500,000 on that gain, or 200,000, whatever, it could push you into the next tax bracket. So if it pushes you into a higher tax bracket because of that short-term capital gain, then now that's gonna impact not only the income you made on that property, but it could impact the rest of your income. So anyways, Mike, and not to get too in depth here, but my
Yeah,
point
so
is,
just be smart.
yeah, 2
Yes,
years is what you want to hold, so you can include the 500,000. But if you can't hold out 2 years, at least hold out more than 1 year, so that you
yes.
get down into this 15% range versus, potentially being in a 24 or 32% range. So anyway, just wanted to point that out.
Good to know. Love it.
Yep,
Yep, that's key.
okay, I think the last thing that I really wanted to mention today, because this is something that's been really real to me over the last couple of years, is I believe that the value of housing is still extremely high. Maybe in recent times, at least, never been higher. And when I think about that, I think about that because we have a relatively scarce amount of an asset, which is residential homes, right? We have 129.9, let's just call it 130 million households in the United States, and there's only 1.3 million homes for sale. So in terms of the amount of supply compared to the amount of households, there's a tremendous amount of scarcity in US housing. But so the scarcity, right? It's a scarce asset. The availability is low. It is a scarce asset. But the utility, I believe, has never been higher. And what I mean by that is, I was reading a article this morning from an economist that was talking about commercial real estate, because I read about commercial real estate all the time. And what they said was, on Mondays and Fridays, on average, this was a commercial real estate company, a leasing company that did a survey from its tenants all across, commercial office tenants all across the country. And they said, okay, what percentage of your office comes into the office on Monday, Tuesday, Wednesday, Thursday, Friday? Approximately 33% of Americans go into the office on Monday and Friday, and approximately 37% of Americans are going into their office on Tuesday, Wednesday, Thursday. So you've got 60 to 70% of the United States, depending on the day, that is using their home as their office. And so you've got this scarce asset, which is the number of housing units in the country. And at the same time, you have the utility, or the value of those properties, at arguably an all-time high, because people are not just using them for a home. I mean, I used to spend 10 hours in my home a day. Now, sometimes I spend 24 hours in my home a day.
Right.
And it's a very interesting, if you think of it from that perspective. So anyways, just one last kind of closing thought there. I want to offer one thing to your group. For sure, making the decision to buy a home in 2022 has more risks than making the decision to buy a house in 2012, right? Because We're more towards the top of the market than we are the bottom. So what we suggest is that you do your due diligence, you really think this through, how long you're going to be in the home, and you make sure that the market that you're considering buying into has really strong fundamentals. And so if you go to this website, which we will drop in the chat here in just a moment, and we'll give to you to put in the comments, you can download our free housing market research guide. And basically it's a 5-step process to evaluate any market in the United States to figure out, is the economy contracting or expanding? Is the jobless rate going up or down? Are wages going up or down? Are the demographically, are people moving in and out? What are the historic appreciation rates in this market? And it'll make you just a lot more educated consumer about any housing market in the country. So we'll drop that in the chat. Feel free to download that guide, and I have to put that on there for regulatory purposes. So if anybody wants to reach out to me, feel free to do so. And Alicia, I'll turn it back over to you. Any questions you might have for me?
Well, I just love what you brought to the table here. I mean, we as CRNAs, whether we're W-2 or 1099, we spend a large portion of our day in thought because we're watching monitors and we're kind of waiting for surgeries to, we've done our work at the beginning, like we've taken the plane off and now we're just flying it. We're on autopilot and we're waiting for the time to come to land. And during that time, we do a lot of thinking about what we could do to expand our wealth. And so this is right on target with what CRNAs want to know. So I'm just so excited that you've got this so that we can look at our own local markets and figure out what we want to do. What is the next good step to take, So that research guide is going to come in very handy. So I want to urge everyone who is here as a participant to copy and paste that. And in fact, would you like me to also copy and paste it in the comments of our group? I'll be glad to do that. Okay.
That'd be wonderful. Yeah,
I will definitely do that. I'm just going to put it in my whiteboard.
And team, if anybody wants a specific consultation to explore what they would qualify for, what program would be best for them, to run numbers, and also have us run an analysis on any area you're looking at purchasing a home, we do so from the standpoint of, just like I would if I was a real estate investor and I was thinking about buying a home there, will literally walk you through the same process that I would go through if I was buying an investment property in that area.
Perfect. That's wonderful.
There's a question from Darlene. Do you offer multifamily or commercial loans to CRNAs? Yes, we actually have access to both of those. And the sometimes ironically, the commercial or multifamily homes can be easier to qualify for because you use the rental income of the asset, the property that they're buying, to offset the payment. So yes, absolutely. Feel free to reach out to us on that, Darlene.
I love it. Go, Darlene. You have got this. I love it. Exactly, Batman. I love it.
Steph, I'm sorry. New York is the only state that we are not currently licensed in, and I'm sorry for that. The New York State regulators, we're on their list somewhere, but we might be like 10 feet up in their paperwork stack, and they're working their way down to us.
I gotcha.
I know. I'm sorry.
Well, all in good time, right?
I hope so. Yes, I think they'll get to us eventually.
Yeah. Minnesota and South Dakota?
Good to go. Love to help you there.
Good deal. I love it. And, New York is tough.
Yeah.
Yeah, we appreciate it, man. This was fantastic. That was right on target. I know I feel better about it. I honestly, after surviving 2008, it does help having lived through that.
100%.
Yeah, so it gives you a feeling of the longevity of buying real estate. And, really being able to, the way you're speaking of it, Josh, where you can really like buy and, let it appreciate and wait, and then, buy another one and then sell the first one. I mean, you could definitely supplement your fantastic CRNA income with real estate income. And then the idea about rental properties, that's genius as well.
And I'm not someone who thinks that everybody should buy. I think that if somebody has a short timeline horizon or isn't sure that they are interested in being a landlord, then there's definitely a place to rent. My takeaway is that if you have plan to be in the home for, let's say, 5 years or more, and if you have the capacity to turn that property into a rental property, you can weather pretty much any storm that's going to come your way.
That's awesome. I love it. I think the highs and lows of the market is what gives others the opportunity to get into it, So.
And there's going to be there's going to be definitely plenty of fear out there, and I'm sure there's going to be plenty of opportunity in the wake of that fear.
Absolutely. So fear is a crazy thing. It gives people who are willing to face risk and fear, gives them the ability to grow. So I love that.
Sure does. Yep, that's exactly right.
Somebody wants you to repeat it. Yeah.
Oh, New York, Kelly. Yeah. So we're licensed to lend in every state but New York. New York has a whole nother regulatory hurdle process, and currently their approval process is about 18 months, and we're 16 months into the 18-month process. So we wouldn't be able to help you there. I do have a recommendation for somebody who's interested in a property in New York, somebody that I've referred business to and I've had really positive feedback. So if anybody wants to email me, I'll drop my email in the chat. I'm happy to introduce you to somebody I know in New York who has done a great job for people in the past.
Oh, that's great. That's good to have connections like that.
Yeah, absolutely.
So we definitely look forward to the next meeting that you come to see us. This was just very inspiring and invigorating, so. You got another question, darling.
Yep, I see that from Catherine. Not necessarily. We would need to see how the contract read, and then what your history is before that in terms of income. So, sometimes we'll get somebody who comes straight out of schooling and they'll go into a 1099 position, and the contract isn't really like specific on the exact amount they're going to get paid or how many hours. It's kind of vague. That can be challenging. But if somebody has a really good history of income and then they're going into a 1099 position, that's less of a hurdle to overcome because they have that history. So I would say reach out to us for a consultation. Let us take a look at the contract and then give you advice. I'm sure we're going to have a solution. The question is just going to be, is that solution going to require 20% down? And is that solution going to be at a higher interest rate than kind of what the conventional loan is? We dropped in a URL, www.crnahomeloans.com. Feel free to, I'll drop that back into the chat as well.
Love that. Yep.
Feel free to go there and just request a consultation. Oh yeah, just left 30 years W2. Yeah, I think there's 100% going to be a solution for you there. Yes. We do VA loans. Yes. Interestingly enough, one of my business partners spent 20 years only doing VA loans before he came to join me, and now he only does medical professional loans and VA loans. So 100% we can help you. I'd love to help you. Feel free to shoot me an email, Michael.
And Josh, I'm putting this link in the chat, in the conversation there, the comment section, in the success community, the 1099 success community. There's been a huge move in the last couple of years post-COVID for CRNAs to move into 1099. So a lot of times they do have these great histories of phenomenal income. We're also in a group of healthcare professionals that is sort of unique in that we have a super high income. We make more than many types of physicians do.
Yeah.
Because there is, not only because of the type of work we do, but the utility, but also because, and there's endless amount of procedures in the US, right? Millions and millions a year, but there's really not enough providers to cover all of those procedures. And
Yeah.
so this is what the sticking point is that we continue to have great incomes, whether we're W-2 or 1099. And we have good longevity in careers. I know, it's funny, CRNAs that are in their 70s and 80s are popping back in to fill these gaps to do procedures.
Wow.
Because there is so much, it's so much work out there. So no one leaves the game, especially the financial game. CRNAs are always gaming the system. So real estate is just a fantastic way to get there. And you're just a great conduit of information. You've just been great.
Thanks.
I'm so glad that you came to join us tonight.
Well, thank you. It's been my pleasure. And also, if there's additional questions, feel free to, if they leave them in your group and you want to forward them to us, email them to us, or give us access to
I'll
answer
do
them.
that.
We're more than happy to answer any real estate or mortgage related questions, because I'm sure there's going to be more.
Absolutely. There definitely will. Awesome. Thank you, Josh. I really appreciate it. Well,
My
we'll
pleasure.
be seeing Josh again soon.
Thanks, everybody. It's been a great evening with you, and here if I can do anything else to serve you.